Okay, so, late 2024, and all that you've sent me, it really paints this picture. Um, a bunch of articles and notes, and, it feels like things are brewing. Like we've got inflation that's stickier than I think a lot of us were hoping for. And then, there's the growing geopolitical unease. Just all adds up, right? That feeling of, well, uncertainty.
Yeah, no, I think you've hit the nail on the head. The sources you sent over definitely point to that. This tension bubbling under the surface,
Yeah.
both in the economy and politically, and not just locally, globally.
And from that backdrop, that kind of sets the stage, right? And from that comes this fascinating, albeit hypothetical
Mm.
scenario. It's actually laid out in some of your material. You called it the Great Market Wobble of early 2025. Sounds a little dramatic.
Yeah,
But as we've kind of talked about off air, it's a plausible chain of events given all the anxieties we see right now.
yeah, exactly.
Yeah.
Yeah, and I think that's important to emphasize. I mean, it is hypothetical, but it's based on real stuff.
Yeah.
Real anxieties that are already out there. It's not just like, oh, we made this up.
Right, right. Okay, so let's dive into like the mechanics of this hypothetical wobble. So your sources highlight a couple of potential flashpoints. The first one centers around February 2025. What's the significance of that date according to this scenario?
So February 2025, this is posited as the moment when this new inflation data is released.
Hmm.
And, everyone's kind of expecting this slowdown, right? That inflation's going to start cooling off. But instead, what happens is it shows that it's persistent, like stubborn,
Hmm.
or even maybe accelerates a little bit in some sectors. And what's fascinating to me about this is that this one data point, this inflation data, could be a trigger.
Because that would really throw a wrench into central banks' plans, wouldn't
No,
it?
absolutely.
Like the expectation that we're going to ease monetary policy. Gone, right? Poof. And instead, you've got fears of even more aggressive rate hikes. And we both know what happens when rates go up, right?
Yeah, I mean, that's borrowing costs, right, for businesses, for people, and that can really slow down economic activity. And then people start worrying, right? Are companies even going to make money? And then that hits stock valuations right in the heart.
So February is like the inflation shock. And then the scenario, this is interesting, it moves to March 2025, and it introduces this other big element, a sharp escalation in geopolitical tensions. Given the current global climate, it does feel pretty relevant.
Yeah, I mean, you can't ignore that.
Yeah.
And the hypothetical scenario, it really hones in on this risk of conflict, like a serious risk of conflict. And it happens in a strategically vital region.
Mm-hmm.
So, you think about the wider implications, and it's like dominoes.
Yeah, you're talking about supply chains getting disrupted, energy prices going through the roof, just this overall feeling of instability in the world. It would make markets pretty nervous, wouldn't it, to say the least?
Absolutely. I mean,
Yeah.
investors are already on edge about inflation, about these rate hikes. And then you add this big geopolitical risk. It's like pouring gasoline on a fire. The uncertainty just explodes.
Okay, so we've got our stage set. We've got the persistent inflation, the threat of these really aggressive central bank moves, and then boom, a huge spike in geopolitical tensions. So what we really want to get into, and this is where your sources get really interesting, is how all of this could actually trigger a major market downturn. And even more interesting is what some of these really well-positioned investors, what they might be doing in all this chaos.
Exactly. Yeah. So we got to break down, like, what does a market crash actually look like? And then we look at the flip side, right? The folks who might be seeing this as an opportunity to load up, to accumulate.
So let's break it down. A market crash, your sources use this really interesting analogy. They talk about the stock market as this giant auction. I thought that was pretty helpful.
It is. Yeah. It's a good way to visualize it. So imagine every share of every company out there. It's constantly being bid on, being offered, up and down, up and down. And the price at any given time. That reflects what everyone in the market thinks, buyers and sellers. Not just about what that company's worth now, but what it might be worth down the road in the future.
So when all these anxieties pop up, worries about inflation eating away at profits, higher rates slowing down growth, or these geopolitical crises messing everything up, how does that affect how people see the future value of companies?
Well, it throws cold water on it.
Right.
All that optimism starts to erode.
Yeah.
Investors start to second guess. Can companies really keep making money in a world that's this messed up? They might start seeing lower revenues, people not spending as much, costs going up for businesses. And all that feeds into this idea that maybe things aren't as rosy as we saw it.
And that shift in perspective, that's what sparks this rush to sell, right? Your sources talk about that. It's like this hallmark of a downturn.
Exactly.
Yeah.
Yeah, if a bunch of investors start thinking a company's future isn't so bright, they want to get out. They want to sell before the price drops even further. It's self-preservation.
Which then leads to that downward spiral we associate with a crash,
Right.
right? More selling, prices plummet, and even more people panic and head for the exits. It just feeds itself.
Right. Like a snowball effect.
Mm.
Negative sentiment and price drops, just going round and round, pushing each other lower and lower. And that rapid and widespread drop in asset values, that's your market crash. It's driven by fear, pure and simple.
But here's where it gets really, really interesting. In the middle of all this panic, all this selling, your sources point to this other trend, and it's almost a counter trend. Some wealthy individuals and institutions, they might actually start buying. Your sources call it heaping. On the surface, it seems kind of counterintuitive.
It does, doesn't it? Like, why buy when everyone else is running for the hills? But when you look at who these investors are, what they have access to, it starts to make sense. And heaping is a big part of how markets work when things get shaky.
So what are the main reasons they might be buying when everyone else is selling?
So a few things. First, these guys, they're not playing the short game. They're thinking long term. They're not worried about what happens in the next quarter. They're looking years, even decades ahead. That lets them see past the immediate panic, the fear.
So they're basically looking beyond the storm clouds then.
Yeah. And they see that when everyone's freaking out, it creates this gap between what something's actually worth and what the market says it's worth, which leads to the second reason, contrarian investing.
The old buy low, sell high.
Exactly. When everyone's selling, they're thinking bargain time. They see opportunity in the chaos. And the third thing, they have access to information and analysis that most of us can only dream of.
They can really dig deep, can't they? Figure out which companies are actually in trouble and which ones are just having a temporary rough patch.
Oh yeah, they've got teams of analysts, researchers. They're doing their due diligence. And that lets them find those hidden gems, the undervalued companies that everyone else is overlooking. And finally, they've got the cash, like serious cash.
And that's key, isn't it? They can actually jump in when others are struggling to get by or too scared to invest.
Absolutely. They can move fast, and that's a huge advantage when prices are dropping.
So we've got why they might be buying. Let's get into what they might be buying. What kind of stuff tends to look good in a market wobble like this?
So the sources highlight a few things. First up, undervalued stocks. This is pretty straightforward. They're looking for solid companies, good fundamentals, strong track record, but their prices tanked because of general panic. They're buying quality at a discount.
Makes sense. Snagging good companies while their price is temporarily down. What else?
Bonds. But, and this is interesting, the sources specifically say potentially specific types. Now, usually when rates go up, bond prices go down. But there are certain bonds, really high-quality government or corporate bonds, that could actually become more attractive, especially if they have a good yield. They become a safe haven in a storm. Like if everyone's worried about inflation, inflation-protected bonds could start looking really good.
So moving towards safety, but also still looking for some return. What about tangible stuff, real estate, for example?
Yeah, the sources mentioned distressed assets in real estate. So when the market crashes, some people, even developers, they get into financial trouble. They might have to sell properties quickly, often at a loss. And guess who's there to scoop them up? Wealthy investors with cash on hand.
Buying when others are forced to sell. That's a recurring theme, isn't it? What about commodities? That feels a bit more niche.
It can be, but the sources give this example. What if oil prices spike because of all this geopolitical instability in, say, a big oil-producing region? Suddenly, investments in energy, whether it's stocks in energy companies or oil futures, start to look really good. So it's about finding those specific commodities that could benefit from the very thing that's causing the market to crash.
So targeted bets within commodities. Interesting. And lastly, they talk about private equity in promising businesses. That's not something most people can easily get into.
No, but it highlights another avenue for these investors. They might find a private company that's got huge potential, but is struggling because of the economy. They can invest, give them the capital they need, and then when the market recovers, boom, huge returns.
So just to recap, they might be buying undervalued stocks, specific types of bonds, distressed real estate, certain commodities like energy, and private equity in up-and-coming businesses. A very strategic approach in the middle of all the selling. Now, this term heaping that your sources use, it suggests they're not just buying a little bit, right?
No, heaping means they're buying a lot, like a noticeable amount. It's not just a few random purchases. It's a coordinated effort to load up on assets.
And that tells us they really believe the market will recover, right? They're not just trying to make a quick buck. They're taking advantage of the fear to buy low and then ride the wave back up.
Exactly. They're thinking long-term, going against the grain, and betting that the true value of these assets will eventually be recognized. And this heaping behavior, it's actually pretty common in market cycles. Downturns are scary, but they also create opportunities for those who are prepared and have the resources to capitalize on them.
So for you, the listener, what's the main takeaway from all this whole deep dive into the hypothetical great market wobble of early 2025 and this heaping behavior?
I think the big thing is this. Even when the market's freaking out, even when it feels like the sky is falling, there are people out there, investors with a lot of experience and even more money, who see it differently. They see opportunity. They're buying when everyone else is selling, and they're doing it because they believe the market will recover. They have a long-term view, and they're willing to wait it out.
And for you, our listener, someone who's trying to understand what's going on in the world, who wants to see things from different angles, what's the key takeaway here?
It's about understanding that markets are complex. They're not just about headlines and knee-jerk reactions. There are different players, different strategies, different motivations at play. When you understand that, you can start to see things more clearly. You can make better decisions, whether you're an investor or just trying to navigate the world.
So here's a final thought for you to chew on. Think about your own perspective, your own investment goals, and then think about what we've talked about today, this potential market wobble, these long-term investors. What does it all mean for you? How might you approach a situation like this? What strategies would you use? What are your motivations? Food for thought.